and a very warm welcome to the show. Good morning, and thank you so much for remaining with us at Smart 24 TV, where we drive your business. This is Financial Markets, and my name is Anthony, and I am your host. Remember, this show is all about investment in the financial markets, both locally and internationally. We bring you expert information on what you need to do with those savings so that they can get a return on them. And the year 2025 is a big catch because there are quite a number of opportunities for you, especially for new investors who would like to enter into the market. You want to know the options you have. You want to know the right people to go to. This is the number one show. Now, as we get into 2025, personal financing is very key to the success of any investor. Managing finances is one of the key roles an investor has to play before investing. Now, joining me on set today to discuss how you can make smart moves in 2025 on your budgeting and financing and eventually investing is none other than Mr. Bukomeko Godfrey, who is the portfolio manager at Old Mutual Group. Old Mutual Group also handles a unit trust fund, a dollar trust fund, and has a number of products as well. We also have Mr. John Muhumuza Kamara from Zeno Technologies. And he's now the country manager at Zeno Investments. You're most welcome, gentlemen, to the show.
Thank you, Anthony.
You're welcome. Let me start with you, John.
Yes.
I have, you're a man of all seasons. You have been through so many ranks, at Zeno, but now you're being country manager, and this is inspiring, first of all, But before you even get into your heavy, I don't know what to call it, but when you look at what you've been through as an individual, you've worked in different institutions, but now you're working with investors at Zeno, and probably you have personal experiences on personal financing. According to statistics, we have very few savers in Uganda. Yeah. When you look at people saving with the Uganda Securities Exchange, buying shares, it's less than 200,000, right? And then when you look at our collective investment schemes, I think we've crossed the 80,000 mark, right? We've just crossed that 80,000 mark. But that is still quite small compared to the 45 million Ugandans we have. What could you share about personal financing? What are some of the experiences you've got, and how should people handle their finances well in their 2025?
First of all, good morning, Anthony. Thank you for the invite. It's always glad to be here, as well as with Godfrey. So personal finance, it's no coincidence. I work in investments. Obviously, I've been interested in finance for a long time. And as any individual who has interacted with money, obviously, I have personal experiences. But particularly for me, it's been an obsession for a long while. Earlier on, I got interested in, how money works. And that leads to how people deal with finance. And that eventually leads you into how financial markets operate and how we interact with financial markets. And that leads you onto the psychology of money. So what I would say, just really as an opener for the conversation, is that personal finance is more personal than it is finance. Yeah, so it varies a lot depending on the individual. It's fraught with psychological biases and behavioral biases that drive us to behave or to act with money in those particular ways we do. There's a variety of ways to utilize money, and you realize most individuals, what they do with their money is very personal to them. Yeah, and it's no wonder it's called personal finance. So it's usually personal. It's usually an image of what the person has been through. People who grew up in a particular era, for example, those who were born maybe from the 70s to the early 80s in Uganda, they saw turmoil in Uganda, they saw instability, they saw shortage. So those people tend to be very conservative with money. Move over to those who were born after maybe, say, 2005, the so-called Gen Zs. These have not maybe experienced the sort of shortages, instability, the scarcity that those born in the 70s. So these act differently with money. they are more liberal. They tend to be more aggressive. So really, finance tends to be very personal. But that said, there are a few good guidelines to use when dealing with personal finance. Of course, that is if you want to achieve some sort of financial success or stability. There are sort of best guidelines or rules you can use, and I'm sure I will get into those.
Sure.
Yeah.
Well, thank you, John.
Thank you.
Godfrey, personal financing. When you talk about investment, you cannot invest what you don't have. And in the first place, when you go to any fund manager or you go to the stock exchange, they ask for money. You can't invest with nothing. However, despite the fact that people have sources of income from employment, business, people handle finances differently. What has been your experience in terms of personal financing, interfacing with different investors? How have people been able to handle finances well or poorly, in your own view?
Yes, so thank you, Anthony, and once again, Godfrey from UAP, former UAP, now Old Mutual Investment Group Uganda.
Yeah.
So it's interesting, we always have to still mention the two so that there can be a connection made.
Yeah.
You see, personal finance, I would equate it easily to financial wellness.
Okay.
And it's more a journey, not a destination. No, rather, it's more a journey, not a destination. What does that mean? We all have a goal in mind. So it's the start of the year 2025. Everyone writing their goals down has a dream. They have a dream to one day have a bank balance or a net worth of a certain number. And that feels more like a destination. But personal finance and wellness is mostly the journey. So the journey is made up of the habits. Yes, and John had mentioned the different segments, the behaviors across the millennials, the Gen Zs, and all the others. But you see, it's the habits you adopt along the journey and the people that you get to take the journey with that enable you to make it there. So what I've seen interacting with the different investors or people that are seeking to reach this particular destination, the ones that have partners along the journey have gotten there easily, or they've been able to build and harness that discipline to be able to take that journey step by step. You see, the one way to eat an elephant is one take at a time. You can't gallop the entire damn thing. And normally, that destination is akin to an elephant. It's a very large outcome, a very large destination. So if you work with your friend circles and say you have a group of friends trying to save money, that is the first place you should go. Because you're going to have like-minded people taking the journey with you and enabling you to have a discipline along that flow. On the other hand, you have to make sure that you can break that goal into smaller sizes. Say you want to save 1 million shillings in a year, and your day job gives you 10,000 shillings every day. Say you're a casual worker, you earn 10,000 shillings every day. If you aim for 1 million for the year, it's going to be a bit tricky for you because there'll be different headwinds that will come and take away whatever you've actually saved. But if you then brought it down to say 250,000 every 3 months, and then have a target. You see, in economics, savings was equal to investments. So saving for saving's sake is not enough. You're not going to be able to reach your goal if you're simply keeping money in the bank. You must have your savings invested. So every 3 months, you could say you're going to invest the 250,000 in a particular saving vehicle. It could be, by the way, a saving within your circle group. It could be a saving within a collective saving vehicle. Yes, it could be your family group or your family members coming together, and that is your contribution to that particular vehicle. Once you place that money there, you're not going to be able to easily access it, meaning it will now add to your portfolio. And as you take the journey through 2025, it's important to have these people who journey with us. Now, of course, this really speaks to the millennials and the younger people because they're the ones who don't have necessarily the large income sizes or who haven't worked long enough to have accumulated the capital to come into the markets. However, they have a high growth potential in their income, and therefore they need these habits to be adopted at a very tender age or at the very beginning of their journeys. So yes, it's important to have that. And the other thing to note is for most investors, it is easy to overestimate what you can save in 1 year, and you'll always underestimate what you can save or invest in 5 years. That means that as you set your 2025 goals, you must also have a 2030 vision, and make sure that your 2025 goals align with that vision. Thank you.
Wow, thank you. That was a great breakdown. John, budgeting and saving. He has mentioned that it's not merely, formally we knew savings as investment. And it's quite tricky because sometimes you need a budget. Sometimes you're living in a tight budget. Uganda, Africa, akasente, kajja katono, but you need to spend and you need to save and invest as well. How do you budget well? I have my brother who personally gave me an offer last year. He told me that every time I would give him 100K, we will add 50K. That's like a 50% return. I withdrew all the money I had in the collective investment in the CIS, and I gave it to him because he had promised a bigger return. I am hoping he's going to fulfill that very soon. But what do you do in such cases where you have so many options? You have to invest, you have to save for emergencies. Emergencies, you can't prepare for them well enough, right? You've lost a loved one, they need money. You've hospitalized your mom. So how do you budget well and save despite whatsoever income you have?
Okay, great point, Anthony. I think the first budgeting is the first thing you must do in order to get your finances in order. Everyone obviously appreciates the fact that to invest, they need money. So it's a common question. You're telling me to invest, where do I get money from? The way that money, so to speak, comes is through budgeting. So every individual, at least one with income, the first thing you must adopt in your daily life, in your life, is budgeting. Now, there are so many methodologies for preparing budgets, personal budgets, and we can go into a few examples if you like. Yeah. But the fundamental point here is that you must have some sort of method in which you budget your money. And budgeting money is contrary to what people think, that it means you're going to be constrained, you're going to, count pennies, you're going to, sort of mize your money. No. Budgeting simply means you account for all the money. So you think about all the things you want and need to do, and then you fix them within a budget. There is a very good reason why governments go through a budget system annually. Of course, it's bureaucratic and tedious, but the reason they go through it is at the scale of government, if you do not budget that money, you'll enter into total financial chaos. You will not know what you're spending, you'll not know what you're collecting, you'll not know your financial position, and it will be a total mess. In that chaos, you'll hardly achieve anything. So same thing with individuals. Most individuals do not budget their money. Now, reasons they give. After all, my money is little, so I spend all of it. The landlord takes this. I don't have any money. Why should I budget? That's not an excuse good enough. You must know where your money goes. So there are various rules around budgeting that can help you sort of with this dilemma. There are rules that make you split your money into certain percentages, and this ensures each major component of your life gets a piece of money. And the thing is with budgeting also tackles some of those psychological biases I mentioned. If you don't properly articulate and write down where your next income is supposed to go, it's going to take the path of least resistance when the money comes. So budgeted money helps you restrict where your money is going. It eliminates impulsive behavior, and it stops you from ruining your own financial future. Usually we are our greatest enemy when it comes to managing our money. It is our impulses, our wrong perceptions, misconceptions, if you like, that lead us downstream. So budgeting really it makes sense of what you have. It puts your current state into check. It divides up your money appropriately. And a budget also, what I've seen personally does, it puts you very much in touch with your financial reality. So if you have a methodology of budgeting, you will quickly realize what your scope of what you can do investment-wise, what you can do in terms of luxury spending. It quickly puts it into perspective. If you use a budget methodology that maybe says 50% of your money's maximum of 50% would go in mandatory expenses, 20% miscellaneous, and 30% into savings, investing, and repaying debt, you quickly realize the maximum you can spend on luxury. And the maximum or the minimums you can spend on these sort of items, a budget helps you put a rule around them. Because if you don't put a sort of rule or framework around it, you're likely to spend more or less in certain key areas that would contribute to your financial well-being.
When should someone budget? Should it be before he gets the money or after?
Before. Okay. Absolutely.
What if boom, money comes out of the blue? There's that money that comes in unplanned.
Yeah, windfalls. Yeah, I mean, if you've already been used to the budgeting process, then every time money comes, your immediate reaction will be like, let's run this through the budget. Yeah, let's run this through the budget. So after is very important. Yeah.
Okay.
Yeah.
Godfrey, budgeting and prioritizing. How do you budget? How do you make sure you're putting your priorities right? Because as Kamara has mentioned, there are rules to the game. If you say 50% is going to expenditure, 20% maybe emergency, and then 30% savings, you stick to that, right? However, things happen, Sometimes you go off track, sometimes you get money unexpectedly. How do you budget and keep within your means as your journey along your personal financing journey?
So allow me to start with that very last statement that you made. So most people approach budgeting by way of matching their means. It's important for anyone out there that's trying to grow an investment culture. You must permanently budget for below your means. So there has to be a portion of your means that you put away. And I'll go back to the basic example. Even if you earned only 10,000 shillings in a day, you can be able to put away 500 shillings or 1,000 shillings. You must first be able to ensure that whatever lifestyle you choose fits below your means.
The 10,000.
Yes, and that will put you perpetually on an upward growth journey. Because you will always have stock for opportunities that come in. Because the same way you get negative happenings across the year, you also get the positives. Now, the way investments work is, to the person that keeps on holding capital or accumulating it, in however small a nature or amount it might be, that person will always get an advantage, like their brother coming to them and saying, give me 100,000 shillings, I give you 50. I give you 50%. Yes? Now, those opportunities everyone gets their day. Everyone gets opportunities across their lifetime. But if you do not live below your means, those opportunities will come to you. You won't be able to take advantage of them, and they will go to the next. So that is really a behavior bias, yes, for most people. Now, then in terms of the question on what happens to when you get a windfall, you see, after you've finished your budgeting, you'll always notice, even for our government, that your income cannot facilitate all your aspirations. You want to buy your girlfriend flowers, you want to go for vacation, you want to buy a new car, you want to move to a bigger apartment. After you've done your budgeting, you realize, actually, I can only buy one pair of shoes in a year. I can only do so much. Meaning, you then get to the next step, which is, how do you grow your income? Because you know that your income now cannot foot your aspirations. So once you know where you're going to grow your income from and what you're going to utilize that for, that's when what you're calling a windfall is most likely you having positioned yourself better to actually be able to get that extra income. So you must then, as you take it back into the budget, you must be allocating it to the other investment needs that come out of your budget. Now, what happens is, over time, you will notice that your interest starts to replace your income. That is, your return on investment starts to match and replace your income gradually. Now, at the point when you've reached where you can cover all your basic needs from your interest income, then you're allowed to become a little bit luxurious or lavish with your life. But beneath that, before that point, and very few people have I met, very few investors who are beyond that point. Before that point, you're supposed to always know, one, what am I trying to achieve investment-wise? So I'll give you a scenario. If I wanted to earn 1 million shillings in a year without working at a 10% return, that means I need to save up to 10 million at a 10% return. Yeah. Now, if I would like to have a year, 2 years from now, where in that particular year, I'm going to have 1 million shillings in income minus me working, that means the first thing I should do in my budget is allocate a portion to that 10 million goal. And if you do not have that, it will be very difficult to be disciplined across all the other budget items. So that brings me to the second point of the budgeting process. You must have anchor items in that budget, or what you can call a theme. For example, this year your theme could be health, your theme could be education, your theme could be. You must have anchor themes that are constantly present in your mind. Yes. Now they go back, and they shouldn't be very complicated, because the more complicated you make the budgeting process, the less the chances that you'll actually go through with it. Yes. If you have 1-2 themes, it's enough. And as long as you have those 1-2 themes, they will always have a need, a financial need, or a capital need larger than your income. That means that you'll always have a pocket where you always post your extra income. And over time, that pocket will start to bring you dividends or returns. Yes, and key to note, we are from the investment space, but these themes do not have to be investment related only. It can also be, as I've mentioned, it could be your health, it could be your education, it could be that you want to invest in your family. But wherever you find value, yes, and utility in your life, that's where you should actually have a theme and be able to focus on that particular theme for at least 2 to 3 years. Thank you.
Amazing. We're going to take a quick break. But before we go into the break, I want to ask each one of you a very personal question, but I hope you'll be glad to respond. How do you budget your money in terms of percentages and apportionments? If you can give us maybe a rule, maybe 50-10, 50-30%. How do you budget? If you can just share.
Gladly. I use the 50-30-20 rule.
Okay.
So the 50-30-20 rule states that you should spend a maximum of 50% of your income, periodic income, on mandatory expenses. For most of us, that would include your mandatory bills, your utilities, your rent, education, school fees, etc. That's at a maximum. Then you should spend a minimum of 30% of your income on savings, investment plans, and repaying debt.
Okay.
So that's a minimum. You can stretch above that. Then you should spend a maximum of 20% on miscellaneous. So miscellaneous is any other things. Luxuries, I feel I need a third pair of shoe.
That pair of shoes is a luxury.
Yeah, I should eat out this weekend. I should have some fun. I should go to Mombasa and so forth.
Go to Nonivi.
Exactly. Yeah. So, reason personally I use this is that I find the framework simple enough, and it ensures that every income you get, you've capped how much you can spend.
Okay.
Luxuries. So this puts luxuries in check, because that's what you're trying to do. You know, luxuries can overrun.
Okay.
I mean, there's so many nice things you can purchase with money. So you really have to cap it somewhere. Then also it puts a floor, a minimum, on how much you can put towards saving and investing. So regardless of the month, of the situation, of the scenario, at least 30%. The consolation I'll have is at least 30% has gone towards growing my investment portfolios and repaying down my existing debt. So that's why I use that method.
Okay.
Yeah.
50, 30, 20. Okay. Godfrey, what's yours?
Yes, actually, when you asked, I was referencing back in my mind to my Excel.
You have an Excel sheet.
But
that's great.
Yes, and mine is really thematic.
Okay.
Yes. I do have a particular business capital I need to place aside into the business. I have particular savings I need to put into my, what you could say is a passive vehicle.
Okay.
Then I have money that I have to put, a portion I need to give away. I have a charity portion.
Okay.
Yes, so in a certain year, I know I'm going to give away this much money. And then after that is split, whatever remains goes to my expenses. Now, when I reference back to my analysis for last year, about 30% of my income went to expenses. 70% fell in the other buckets. Now, it's because as the income comes in, I position first across, I split across the themes, and what's left after, I can spend
How you want.
how I want. Yes, and that means that very little gets spent compared to what would happen if I give myself a different other band. But it's because I'm very disciplined across the other three. And then I have accountability partners, people who also, we sit together, they write down their themes, and then every 2-3 months, we sit and, you open the books. You show exactly what you're doing about these goals. Now, we do know that you can lose track of your expenses. For example, if you've gone to non-EV, you might go with a budget of 100,000 shillings and meet your OBs and OGs. And then the night goes the other way. Now, on my side, it will never happen because the only thing I can do is if I overspend, it's going to take away from the other expense lines. But the investment bucket, the charity buckets, these are never going to be adjusted, and they are set prior. So as you're having Christmas, normally Boxing Day is the time to set those goals. And I spend those days alone setting those goals. And then once I'm done with that, I start there knowing that if there's anything considered above budget, yes, say if I want to buy a new car in that year, then I will know that this is not within the scope of my income, so I need to look for extra income some other way to finance that. Why do I do that? These themes plug into my long-term goals. Yes, and that's very, very important. So you don't want to go through a life where I've had people who have saved money for so long at significantly low interest on bank accounts simply because they never had any thematic end to it. So if you have that goal in mind, it will anchor you down, and that continues to anchor me.
Amazing. Yes. Amazing. That's it. That's it. And you've heard from the gentleman right there. Kamara uses the 50, 20, 30% rule. And then from Godfrey, what you're getting is he puts his priorities first, and the rest he can spend. But after spending on the big priorities, that is investment and saving. Key to all this is you have to budget. You have to have something put aside every time, and knowing that you're spending within your means. My name is Anthony. We're going to take a quick breather. When we do return, we get into the debt and credit segment, and then we also look at the investment part. What are some of the opportunities that 2025 is providing for you, and how can you get out of debt? Kamara mentioned there that he also budgets for debt, right? So debt is also a very important issue. Now, we return shortly after this quick breather. Do not touch your dial. Welcome back, and thank you so much for tuning into Smart 24 TV once again. The discussion tonight is on personal financing and also positioning yourself strategically for gains in the year 2025. One of the things I know all of you are doing is New Year resolutions, and one of them is to see that you end 2025 very strong financially, with a very strong financial muscle, with a huge portfolio, perhaps millions, perhaps billions of worth of portfolio. However, to do this, we must be able to follow through the rules that money actually has to obey. When you don't follow the rules that money presents, you will definitely lose the money. And in the first segment, we talked about budgeting. We've talked about how you can be able to, structure your budget and live within the means that you are earning, but also looking at increasing your sources of income, because that's also another very great kicker. Now, John, when you talked about your budgeting process, you also talked about debt and credit. Now, managing debt and credit usually comes as a result of people who have spent beyond their means, or people have gotten into problems, now they need to recover, they need some debt. How do they handle that? How do you handle your debt and credit? I know someone I gave my 500,000 at campus. I don't know if he's watching, he didn't pay back, you know. He still hurts me up to now because he's now famous. I even watch him on TV sometimes. But I can't approach him, though it is a pain in my heart. So the people out there also who don't want to pay back, you know, it's also not good, you know.
Yeah.
But also we can't live without debt sometimes, right?
Yeah.
Even government borrows, everyone borrows, right?
Yeah.
At some point. So how do we manage that?
Yeah, thanks. That's a great point when discussing personal finance. As you mentioned, most people need money for some reason or the other, and the only way to access it sometimes is to borrow. In terms of personal finance and even corporate finance, I always insist that you should be extremely cautious with debt. The reason why is that having access to money via borrowing or via credit usually leads people to overreach, to be excessive, and to end up in sort of precarious financial positions. So I always insist you should approach it with a lot of caution. So what does this mean? Again, you have to conduct your affairs in such a way that you minimize the amount and the frequency with which you need to draw credit, irregardless of if it is available and accessible. For most people, I know the issue is if there is no credit available, I can't access a loan. That's the most issue. But what for me is fundamental is that even if it's available, that's besides the point. You should minimize the use of it, the amount and the frequency. If you look back in the history of business and corporations, the single common factor that has been in play whenever there's been financial implosion, where we've seen financial markets or companies implode and go bust and bankruptcies and so forth, debt is always at the center of that.
That's right.
Yeah, so you really have to be cautious with it. People are going to tell you, you know, if the debt comes at a low cost, if the interest rate is low, it's very okay to borrow. But there's a lot of psychology at play here. Sure. When you continue to draw easy money, if I may call it, it makes you tend to overreach, you tend to get overambitious, you get into excesses.
You live large.
And yes, and that is where financial ruin begins. So if you're optimizing for financial security and being able to stay in the game long, and by in the game I mean always having that small amount Godfrey talked about that's available to continuously invest. If you want to optimize for always being in that situation, if you want to optimize for eliminating financial ruin, then you need to be extremely cautious with debt. So always, you know, access or use less debt than you have access to. Sure. If you're at the limit of your credit capacity, that should be a red flag on a personal finance level. You should always be somewhere under it. Yeah. And when I mentioned in the 50-30-20 rule, 30% going to repaying debt, that model for budgeting factors in that sort of belief or that theory that you should always be putting a certain amount towards repaying your debts. But also you realize if you always allocate a portion to repaying your debts, you're really working towards lowering the amount of debt you tend to carry. Yeah, so debt is usually risky. In more cases than all, debt usually tends to drive people into financial ruin. So from a very cautious point of view, there are those who you may see gamble with it and do well, but on a sample of the population, I would advise they go cautious with it.
Amazing.
Yeah.
Godfrey, John is is saying debt is really something you should handle with care and something you take cautiously. However, there's a man called Robert Kiyosaki, the rich dad, poor dad author. He said, take debt. I mean, the banks have money. You know, you just need to go get that money, use it, pay, but keep keep the balance. You keep paying the credit, but you're still earning from that debt. What is your perspective in terms of how much debt someone can take, when someone should actually borrow, and by how much, and for what?
Yes. So thank you. So largely, I agree with John, not with Robert. And this is why. You see, most things said in singularity are actually correct, but there are many qualifiers to a certain statement. Now, debt can be your tool for wealth or your bridge to poverty. Now, for most of the masses, we don't have the understanding or the appreciation or the money habits that can enable us to use debt as a tool for wealth. If you talk to most banks and you look at their NPLs, their NPLs, all the category just below that is filled with young people, young corporates, young businesses that have actually borrowed. What they're doing is they're borrowing close to 80% of their capital, 90% of their capital from the bank. Once you're in such a situation, you're 80% levered, you are very, very close to financial implosion. If you're a business person, you're one delayed LPO payment away from said default. If you're a career person, you're just a small error at work away from the default, and you don't want to be on the back end of that stick. So I'll give you a personal story here. And this is why I said it can be a bridge to poverty or a tool for wealth. So someone I won't mention lost their job. Yes. And before then, they had utilized close to 100% of their debt limit. It took them, even while they were unemployed, they had to look for money to keep servicing the debt. And because of that, they had to cut or lower their living standards to such a minuscule level. Yeah, so the bank became the boss. And when they got another job, the first thing they did was to pay 90% of their paycheck into the debt, such that the debt can go to zero. Now, the day they finished off the debt, they started paying 90% of that particular salary into investments. And today they own their own house.
Wow.
Yeah. But they said, when they paid off the debt, the bank told them, look, if you want to own a house, we can give you a mortgage.
They always have that. Yeah.
Just in that very discussion, when they went home, the wife told him, actually, like, you see, if you want to suffer for another 2 years, no, if you want to suffer like you suffered the past 2 years for another 20 years, then we can take on the mortgage. Now, when is it okay to take debt? Yes. Normally, it's okay to take debt if you're really caught up in a crisis. Yes. For example, you really have nothing, you've used up your rainy day funds, and the crisis you're dealing with has exceeded your current size of your wallet. There, one would understand, but then you have to also appreciate that the reason it's a rainy day fund is that once you exceed it for the next few months or years, you have to actually take the pain of paying off that debt quickly. Back to what you said, you need to pay off debt quickly so that the interest component is limited. The other time, which is the only time wealthy people ever take debt, is when it is as a complement to their project. So I'll give a scenario that anyone can understand. Assume you want to build rentals, yes, and you're into property, and the property is going to cost you $100,000, and you've already saved $60,000, yes, and you know for sure that if you borrow that $40,000, yes, and that is your only input, your property value or return on investment is going to be north of 25 to 30% on that particular $40,000. And you also have other income sources to service the same $40,000. You will then be allowed to take on that $40,000, but again, not for 20 years. It has to be for a short period of time.
So the interest.
Here's how debt can destroy you. However disciplined you are. Debt is more disciplined than most of us here. Because debt, if you have to pay every first of the month, you will never be pardoned. On the first of the month, you have to pay. Yeah. So if you take debt for 20 years, you're going to be paying that compounding interest to the bank for 20 years. But I struggle to find someone who is as disciplined in paying to themselves the same way they would pay a bank in terms of debt payments. So assume you took a mortgage, a virtual, non-existent mortgage, and it requires you to pay $1 million shillings, and your salary is say 3 million shillings net. Very few people can earn the 3 million shillings net and pay each other 1 million shillings per month for 20 years. But if you're able to do that, at the end of those 20 years, you're going to have close to $500 million shillings, if not even more, because of the compounding aspect. So if you're using debt, it has to be in short-term intervals for highly productive, non-speculative investment. Don't take debt for you're opening a shop, you're buying a taxi, you're buying a car for Uber, investments which are speculative. If you take debt for investments that are speculative, you are 9 times out of 10, with the 10% left for those that are lucky, going to end up in a situation where you have to not only liquidate that particular investment, but also liquidate your savings to service the same debt. That aside, when you've taken on debt, just to reiterate what John said, it's important that you stay disciplined and never default. Because once you get into that rut, again, you can never come back. At a certain point, my friend owed twice the amount he borrowed. Now, that's because of defaults.
Yeah.
Yes? Now, imagine what happens at that point. If you borrowed 20 million and now you owe 40 million, but you don't have a job, how would you sleep at night? So debt actually is like, debt is one way for you to work for a bank, minus you are having gotten an unemployment contract for the bank.
Yeah,
That's right.
Yeah. So if you want to work for a bank, it's easy.
Yeah.
Take a loan from the bank. Yeah. The bank, you'll have to give a bank an update every month, either by way of a paycheck or by explaining exactly how you didn't meet your KPIs and how you intend to meet them, just like the bank employee.
Wow.
Yeah. So the advice is go really slow.
Yeah. Go
with
slow
debt.
on debt.
And
Yes.
and to just crown it all, slow is actually the fastest way. I'll take you back to the elephant aspect. If you want to finish 10 years with 100 million shillings in your savings, if you start with about 15 million shillings today, you only need to put aside 250,000 per month for 10 years, and you have 100 million shillings. Slow is
Principle.
Yes, slow is the fastest way to building wealth. And that simply means you accumulate your good financial and money habits and just stick to them, and they accumulate to what you need. Yes, but in events or cases where you can get a guaranteed business, like a guaranteed LPO, you have a particular property that you can see has particularly steady metrics, basically self-financing security. At that particular point, it's okay. But again, before you convince yourself that it is self-financing, meet a financial advisor. Walk them through your numbers so that you're not really hallucinating. Many people hallucinate as they convince themselves of the prospects of the project such that they can convince themselves to take out the debt so they can allocate it to a wedding, allocate it to a car, simply because they need the money. So make sure you don't do that. And please do not take a loan for a home like a home loan. Don't take a loan for basic needs. Yeah, you
To eat.
do not a home, a car, all those things. Those are the early pitfalls, the early mistakes committed by young people, young corporates, that eventually drown them.
Yeah.
Your car, if you can't afford a car out of pocket, Uber is there, bodabodas are there, it's good to walk. Yes, if your girlfriend will not be your girlfriend if you don't have a car, she's probably not the one. Just don't take the debt, because it will stay longer than she will stay with you.
That's right. Kamara, you were burning with something.
Yeah,
Yes.
and you see, just to add on to what he said, personal finance, I think on the debt issue, there's lessons to borrow from corporate finance. Corporate finance is usually more strict. The process a company goes through to borrow money is usually stringent. Their board has to sit, management has to propose, their cash flows have to be interrogated, their balance sheet has to be stripped apart to see if it can accommodate that debt. Now, when it comes to personal finance, especially young corporates and employees, all that is looked at is their income. Yeah, so now I would challenge people to borrow the balance sheet aspect from corporate finance. When corporates are borrowing, the amount of debt they usually are extended is looked at strictly in a proportion to how much assets or how much equity is on their balance sheet. So moving over that to personal finance, you, Anthony, if you want to borrow 10 million shillings, I would ask you, what proportion of 10 million is it to your total assets that you hold now? If your total net worth or assets is 15 million, I don't think you should be borrowing 10 million. You should be somewhere below 30% of that or 20%. So that's another lesson you can borrow. I mean, look at the size of your asset base. It should tell you if the amount of debt you're taking is really can threaten your financial standing or if you can handle. Yeah.
Wow, that's amazing. You guys remind me of a gentleman who said, "Don't celebrate when you get the loan or the credit. Celebrate when you pay it back." Some people, the moment they borrow, their lifestyle changes, and this is off of borrowed money, and then eventually they get back from where they started, or even below where they started from, and the cycle continues.
Yeah.
So hopefully, our viewers will take that very seriously. However, we want to also look at our priorities this year in terms of investment. Old Mutual Group has several products, Godfrey, and one of them being the Unit Trust Fund. You'll tell us more if you have for the year 2025. However, you can also give us a wider view of what our investors can do in the financial markets within Uganda, the Ugandan space. There's a gentleman called Kakande Alex who always sends emails on treasury bonds and shows you all these prospects. Someone at 30 can construct their dream house if they served for the past 10 years with a particular yield, from a bond, and it's interesting. So, what nuggets can you share, Godfrey, about the year 2025 that the opportunities that are there for our investors in the financial markets?
Yes, so thank you. First, I will give a sort of like an overview of 2024 in terms of Uganda and then the global side.
Yeah.
So when you look at the Ugandan landscape, 2024 yields by the close of the year were high up to 17.5 on the 20-year. The 1 year was high up to 15%. These are returns which you would struggle to get in consistent return on investment in terms of a business. So even when you look at the balance sheets of different banks, the bigger corporate entities, these are very good returns. On the other hand, within Old Mutual, we are also looking to bring to you the alternative investment space.
Okay.
This is in the renewable energy space, the property side, agriculture, and a varied set of other alternative investments.
Okay.
And that was also in the works in 2024, and we should be expected to roll out into this year. One other highlight is now bringing back also in light of the global side. See, these opportunities have been in the markets and they have been around. Yes, the global fixed income markets have been they reached their highest in about 10 years, but also the equity space performed very good, very, very well. So they're what they call the significant seven. These are the likes of Nvidia. People do know Tesla. Yeah. And all of these other big stocks that people do know about. These returned on average in north of 35 to 45% return in just the year 2024. These are opportunities that are available.
I think Nvidia was on top of that list.
Yes, and the momentum is still going. Yes, and these are investments that are available to everyone. Now, that brings in the aspect of Old Mutual. For you to know what's happening in the markets, to take advantage of that, you need a financial advisor. Yes, and this financial advisor is supposed to take that journey with you and to show you what you should invest in vis-a-vis your goals, your risk appetite, and also what's there in the markets. And once you're talking to that financial advisor, one of the key products that you will have to look into is a passive vehicle, which are the collective investment schemes. We recently launched the Old Mutual Dollar Unit Trust Fund. Formerly, we've had the Umbrella Unit Trust Fund, which is the unit trust, and these were in Ugandan shillings. But now you're able to invest both in dollars and in the Ugandan shillings.
There's a contention on that. Why the Dollar Unit Trust Fund? Are there perks that come with investing in the Dollar Unit Trust Fund other than the umbrella, which we're used to?
Both of them are umbrella funds.
Okay.
The other one is Ugandan shillings. Okay. This is the dollar. Now, there are people out there who earn money in dollars, and also spend in dollars. For them, it's excellent. Then the people out there who have money in dollars seated on accounts waiting for expense. Say, for example, you're a business person and every day you make sales and you have that money seated on an account in dollars, and they are not, those dollars are earning nothing. So you're better off putting that money in the dollar fund, and when you need it, it is a very easy process for withdrawing it.
Okay.
Yes, and then there are also people in the diaspora who need to send money back home, such that when they come, they can then take on different investments.
That's right.
So different calibers of people can take advantage of the dollar fund.
Okay.
That said, even on the Uganda shilling side, the returns are very, very good.
What's the average this year? Or
So
we are yet to.
So the return for the year was about 11.8%.
Okay.
And that's net return to the, and this is net, not annualized return. This is net annual return. Yes.
Okay.
So and once you annualize that, it can go up to 12 point something. But it's important we report the net return that you will see on your statement.
That's right.
And the returns with Old Mutual are very transparent, meaning every day you see how much you're earning on your statement and how that is compounding. And this return compounds daily.
Yeah.
Yes. Now that is a passive income vehicle. But on the other side, if you also want to participate in the stock markets, for example, Kenya last year, the Nairobi Securities Exchange, this is mostly on the indices. They also performed very well, about 35% on average across all of them. They have about 4 categories, but then particular stocks like KCB Bank had a total return of about 90%. So there are different opportunities in the market we see. And when you come to us, we have a stock brokerage unit that can be able to walk you through how you can participate in the equities, how you can get to buy them, take advantage of these markets, and also advise you on which ones to buy and which ones not to buy. And I will emphasize this: you must take the journey with a professional advisor.
Yeah.
If you have a dental problem and I'm your brother, will you come to me in the bathroom and I tell you anything and you do it? No, you won't. You will actually go to a dentist. Yes. So even when it comes to finance, yes, I mean, we all have teeth, but we don't all understand teeth. So we all have money, but not all of us understand money because we interact with money at different levels with different knowledge bases. Yeah. So you need to get to a professional advisor and take the journey with them. It will take you a lot further in a shorter time span than someone who takes that journey alone.
That's right.
Thank you.
Thank you so much, Godfrey. Kamara, at Zeno Investments, you're very well known for innovating new products. Also, your interface online has been very good.
Yeah.
In the year 2025, what do you have for the investors?
Yeah. So for 2025, again, we continue to reiterate the same sort of theme: is that investing for most of us is a means to an end. It's not an end itself. So that brings you back to sort of the things we've been talking about. What are you investing for? What are your financial goals? So it is from that framework that you sort of now get to know what to invest in, how much to invest, which assets to look for, and so forth. He mentioned the aspect of a financial advisor. So that is in sort of the same light, is that investing is a means to an end. There are portfolios last year that could have returned 8%. There are portfolios that returned 65%. But that does not mean I should pick the portfolio that returned 65% last year for this year. And of course, as you know, Anthony, I'm very aware of giving tips. So I will really refrain from mentioning particular asset classes in case it's taken that I'm marking them for high returns in the following year or this year. Yeah. So really, we continue to insist on a portfolio perspective. Having it tied to a particular financial goal, because different financial goals would need different investments to support them to happen. Yeah, investing is really a means to an end. You're not investing for the sake of investing. What do you care if you own a bond? In real sense, what you care is what you're going to get out. Yeah, for you to use for. for your retirement, for your lifestyle, for paying your child's education, and so forth. So you're not just buying gold or a bond or a particular stock just so you can say you have a stock. Well, I know some people do, but maybe they are young and they quickly get over it. Yeah, it's just childish. Yeah, so you're investing for a particular purpose. So these assets you assemble, bonds, stocks, gold, property, etc., they are working for you to deliver for you a certain monetary gain. Yeah, so that you take that monetary gain and convert it into any personal conveniences, pleasures, and aspects that are important to you. Yeah. There are many rich people who have a bunch of investment assets, and that money is for charity. Yeah. All that money is going to charity. So that's what that financial gain will do. Yeah. So again, we continue to insist on that approach. And for 2025, again, in light with our philosophy and value proposition, we're always trying to tackle investments with the behavioral aspect in mind, because we figured that the reason most people are not investing as much as they should is behavioral. It's not really that they don't have money. Yeah, and so forth. So in that light, we're always trying to innovate around to make it easy. Why isn't Anthony putting aside money every month? Yet he knows he'll need money 5 years from now. He knows he'll need to buy a house. He knows he'll need to take his kids to school. He knows he needs money for emergency. But guess what? Every other 30-day period passes. Anthony earns a salary, but has a reason why this month, I've not been able to save, I'll do it next month. That sort of thing. Yeah, so on top of the various features we have, we've extended our autosave feature to cross over to bank. If you are not familiar with our autosave feature, it allowed you to automate your savings deductions from your mobile money. And again, we thought of this because the feedback is that people tend to have the money, but they don't have the discipline. Yeah, so Godfrey mentioned the fact that
pain of sending
yes,
money.
yeah. So Godfrey mentioned the aspect of how repaying a loan people are disciplined. Every first of the month, the money goes. Yeah, why? They have no choice. The bank probably grabs the money from the account. You don't even asked about it. No, you're not consulted. The money is picked. So we flip this over. So do the same for your investments. Take your investments that seriously. So what it allows you to is authorize the bank or mobile money to pick that, say, 1 million shillings every first of the month. Send it to my retirement account. So that you don't have to think about it, you don't have to debate. Because if you open these things up to debate, there's always something. You'll say, I think this month the biggest problem is I have to first do this, there's this wedding, I have to send these contributions. You get lost in so many things. So month goes by, month after month after month. A year is very short. I think now all of us can agree. A year is no longer. It used to be long in school. When you were in school, a year was long. Now, a year is very short. So a year will go by and you've not met your financial goals. Why? You didn't have a system to put money. Yeah, so we've extended autosave from mobile, and we've now also made it available on bank. First bank we've partnered with is Stanbic Bank. So what that will allow you to do is, again, automate your savings through our application to pick money directly from your bank account and send it to any of your investment goals automated without any input from you. Yeah, so we feel that that should also continue to change how people save and invest.
Wow, thank you so much, John. Thank you, Godfrey. Our time is fast spent. You can see, I know it's not that much, right? And we have been very honored to have you guys. Thank you so much.
Thank you too.
Thank you, Anthony.
You're welcome.
Yes.
And that's it from us, ladies and gentlemen. Thank you so much. If you missed any of the content, remember to follow us on social media. On X, we are Smart24 TV now, and on our YouTube channel, Smart24 TV Live. My name is Anthony. I'll catch you next time, same place and same time. Bye for now.